Could the AI buildout be entering a new phase? And if it is, what does that mean for the stock market? Hello, and thanks for joining us for this week's fastest 4 minutes in finance. I'm Scott Inman. LPL Research just released its mid-year outlook for 2026, and they are still bullish on the stock market for the remainder of the year. But the title of the report, Policy, Buildouts, and Bottlenecks, hint at the cautions investors should have moving forward. As we record this, the S&P 500 index is up more than 8% year to date. If 2026 ends in the green, it would be the fourth straight year of positive returns. And that would not actually be unusual. According to LPL, market expansions that make it to year 4 usually do generate strong gains that year. In fact, the last negative fourth year for the S&P 500 came during the first bull market after World War II, more than 70 years ago. And 5 out of the last 7 periods of stock market appreciation have experienced double-digit gains in that fourth year. Having said that, the direction of the stock market moving forward will be tied to artificial intelligence. It's really not about if AI will be implemented, but now it's about when. I'm reminded of commentary from First Trust chief economist Brian Wesbury. When talking about the dot-com boom and bust, he said investors were actually right, they were just early. In other words, they sunk their dollars into companies that were not yet profitable. Some never made it. Others, it took time. Much of the AI trade has been driven by the promise of the future and the growth potential of the companies involved. Take a look at this chart showing the 5 companies known as the AI hyperscalers. This shows the combined spending over the past 6 years and forecast spending for the next year expected from Oracle, Alphabet, Amazon, Meta, and Microsoft. These 5 companies are on track to invest more than $750 billion in AI infrastructure this year and may spend more than $1 trillion in 2027. The earnings growth driven by their investment has been historic. The technology sector grew profits by 54% during the first quarter of this year. But as these companies continue to spend, they're no longer able to do it from huge cash reserves. Take a look at this chart. This shows that the same 5 companies issued roughly $110 billion of bonds in 2025, and estimates point toward $300 billion in 2026. LPL points out building data centers, securing chips, and powering them requires sums beyond even those companies' formidable cash flows. That's not necessarily a bad thing. The borrowing companies are still in excellent financial shape, but it does point out the next phase of the AI build-out will be different, and investors may no longer buy on optimism but expect results. As LPL puts it, AI's first act is spending, and it's still going. The next act will be monetization.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.